if you see these credit spreads widen, and now we've said, okay, well, that probably comes in the form of checking your account, your brokerage account, and seeing that your bond mutual funds or ETFs or even direct position bonds, the pricing on those is going down, right? So it feels like you have less money in your account. Meanwhile, you still, unless there's default, you're still going to get the yield that you were always promised. And that comes not on a percentage. The yield really comes in a fixed rate for the most part here, right? Like your yield is just a derivative of how much that dollar is coming in is relative to the current price of the bond. And so after it widens and you see your price go down, you still get the yield. And then the Fed, your theory is that the Fed would act and essentially you see that credit spread retighten, which means the price is going to come back up.
Right.
So,
and you have that yield locked in at that point.
Right. So very, very, painful roller coaster to ride from an emotional standpoint of watching your assets go up and down and up and down. However, it could, if you don't have the ability to take action and do something else when this type of thing is going on in the markets, you want to probably know what's going on for the purpose of being able to say, okay, I need to not make a foolish decision here and sort of ride this out.
Yeah. And also it's just a good reminder of why rebalancing makes sense.
Yep. Okay.
Because, if you're rebalancing, you're buying, you're effectively selling your winning area, your winning asset class, and then buying the losing asset class to get back to some normalization of target weightings.
Yeah.
So as spreads widen, the implication would be if you're rebalancing right against AAA, you're going to be selling AAA and buying junk as junk debt or high yield as the yields are rising. So that automatic rebalance, that's another reason why automatic rebalancing makes a ton of sense, because despite me sounding the alarm around sort of near-term risks, I could be totally off on the timing, still right on the destination, not the way you get there. But the rebalancing will handle that for you.
Right.
Right. And that's a big difference between somebody who's active and tactical and has more of a trader mindset versus a much more 20-year type horizon.
Right. Well, I think a lot of times too, people, the most common rebalancing that I see that most people actually get is what I call a calendarized rebalancing, right? Once a quarter, their account's rebalancing, typically because that's what their, advisor, financial professional is doing. And it doesn't really kind of matter on that day if the stocks, are way up and the bonds are way down or vice versa or whatever. It's just like, oh, it's the last day of the quarter or whatever. Today is when we rebalance. And I think what you're highlighting is that can leave a lot of opportunity on the table because if intra-quarter, right? Like if you look at, now this is almost a poor example because it happened so close to the end of the quarter, but COVID as an example, if that had happened, let's say that happened 4 weeks earlier, like in the middle of February, right. Your portfolio would have missed its opportunity to rebalance and grab, all that extra upside capture when the market kind of rebounded, right? If you were saying, well, I'm going to wait till the end of the quarter to do my rebalance. So that's the difference between a calendar rebalancing and a systematic rebalancing. And I am a big fan of systematic rebalancing for that exact reason. Yep. Super good point. I didn't think you were going to bring that up today, but super valid.
No, it's important because it's like the question with all this stuff is, it's like, what do you do with the information?
Yeah.
Like, we're in an industry where everyone's talking and has an opinion and everyone's great analysis. And I'm among that crowd too with my own research, right? But it's always about, well, what do you do with it, right? I mean, you can either take a proactive stance, in which case you hope the cycle favors the way you're expressing the trade.
Yeah.
Right? Or you just say, you know what? I recognize this is something that can happen. I have a set asset allocation. I'm just going to have this be automated and I'm not going to stress, because even though you have the rebalancing, it's still going to be painful. Right, you're going to have a drawdown. You're going to lose money during that period. You're going to be buying into the decline, and that decline could get worse.
Oh yeah,
right, which is a whole another psychological aspect to kind of keep in the back of your mind. But it's just two different types of ways of thinking about how to manage risk.
Mm-hmm. Well, I think risk in portfolios is so mismanaged, oftentimes, anyways, especially for just the mass affluent of the U.S. The 60-40 portfolio built up on a standard Sharpe ratio, I think is, and I'll probably catch a lot of flack for saying this, but I don't think it's the end all be all. I don't think it's the best way to manage a portfolio, even if your focus is on, low cost index funds or whatever that's your approach. I think it's always a question of, okay, well, what index still? Because all an index is, and people forget this, is an index now is just, it is an actively managed strategy that is systematized. And so now people replicate it within a fund and it just becomes cheap. So it is still a form of active management under the hood, right? That selection of, well, what's in the index and how does it get there? That's technically an active process. And people like it because it performs okay to the upside, right? The return performance is usually pretty good, especially in the US. Outside of the US, maybe not so much. They completely disregard the risk and they build this portfolio. Well, I want a little bit of this index and a little bit of that index. Oftentimes you look at it and say, well, the correlations are actually quite high. I'm not really sure you're getting the diversification out of this that you're looking for anyways. And then you get to bond indexes, and that's a whole nother, animal, right? If you look at like the effective duration on the egg that had just creeped up, and all of a sudden, you end up with 40% of your portfolio is a mixture of bonds that have, all the downside risk, very limited upside risk, and it's carrying very little yield. It's not doing much for you. Like, that's a huge mismanagement of risk in a portfolio. People have learned that the hard way now since 2022. And I think that's what you're coming back to now is like, so what do you do with this information, right? There is this possibility out there. And I think what you do with it is you understand what's going on in the markets, because I think it can help people just weather the storm a little bit easier emotionally, right? I think we know, and I think it's commonly understood now that if you sold your entire portfolio at the end of March of 2020, it turned out really bad for you. I mean, that's really bad. Now, if you sold earlier in March and got back in at some point or something, right? You make tactical moves. That could have worked out. It might have worked out. But if you understand what's going on in the markets and how leverage is becoming unwound, this or that, and what the Fed does and how that affects, it helps you just say, okay, look, I don't understand everything about this, but I understand that I need to not make rash decisions. I should talk to an advisor that understands what's going on. And it's going to probably be okay if I have a long enough time horizon, right? And that's always a big if, but if I have the time horizon. And then the second piece of information is, well, if you're ready and you're looking for something like this and you are in a position where you can make, strategic moves and reallocations and do stuff like that, there might be some really good opportunity when everyone else is scared, right? And that's the old Buffett quote, be fearful when others are greedy and greedy when others are fearful. And so as, major things come unwound and the system's deleveraging and there's, correction, crash, whatever you want to call it, like there's that big price change in the market, might be your opportunity. And I heard, I got to remember who said this. It was at the last NAME conference in Chicago last fall. And they said the best trades you'll make in your entire career will be the most difficult to take.
Oh, of course. Yeah. I think Walter Deemer said something along the lines of, but by the time when it's time to buy, you won't want to, or something along those lines.
Yeah.
Right. Which is spot on. Goes back to the rebalancing, automation, and just having a systematic approach, because you have to not be emotional. Now, you can communicate emotionally. It doesn't mean you act emotionally.
Oh yeah.
Right?
Well, I think anyone that follows you on Twitter knows that.
Yeah, exactly right. I mean, I'm inherently I am a quant and rules-based, manager, and the way that I think about things is actually using things that I know has some degree of back-tested proof and evidence behind it. But you gotta play the communication game too.
Yeah. And just to touch on the backtesting thing, I assume your research is backtested. You're not saying that you have a strategy per se or something off the wall that we're saying is backtested. Anyways,
it's more about knowing what works.
Yeah, research is backtested.